testing affordability is not just day one and say, can the customer pay the first installment? And in that regard, what we look at is the customer's income. We require a payslip to verify the customer's income. We have a look at the credit bureau to determine the total debt servicing costs that the customer has on a monthly basis. And we then ask the customer to declare what their living expenses are. And taking those into account, those three parts, we then arrive at what we determine to be the free cash flow that the customer has in a month to be able to service additional debt. Of the three components, the living expense one is the one that there's very little control, so to speak, in that you cannot verify that with the customer, short of asking them to produce all their grocery bills and the like, which is just not practical. So whilst we ask a customer to actually declare what the living expenses are, it's pretty much like a medical. When someone goes to a doctor and you say, yes, you only have one drink a week, customers therefore are aware fully that the smaller that living expense number is, they believe the higher the probability is of them getting a loan. And the consultants also in the past were aware of that. So what we have done is we work with the Bureau of Economic Research, where they determine what the living expense is based on household income. So we look at the individual's income, and based on that we have a default minimum, meaning that if a customer declares a living expense that is less than that amount, our system will automatically default to the higher amount that we have in the system and then calculate affordability on that basis.